Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. This week's episode features a discussion about why one may consider refinancing. As the Australian economy gets back to normal on the back of the COVID-19 enforced shutdowns, and of course there are some more being introduced, borrowers are sitting in an enviable position. The moment lockdown measures started, RBA quickly cut the official cash rate to a record low of 0.25%, and as we've seen, as at the end of the year, we're still even below that at 0.1%. Now, what that means for borrowers is that this is the cheapest time since the 1950s to access money, and whether or not that's the best for you is another question, but it's definitely the cheapest in terms of monetary figures. And if you've already got a home loan, then you should consider refinancing to take advantage of the revised low cash rate and to make sure that you're getting the very best deal that you can possibly achieve. Here are some of the benefits and reasons that you may consider for refinancing. And of course, this isn't an extensive list. This is merely just to summarize some of the key points that are important to most borrowers. Number 1, better interest rates. The first thing to understand is what exactly it means to refinance. And basically what a refinance is that you're just moving the same, or you're taking out a new home loan on the same property and shifting it between lenders or possibly within the same lender. You could be doing a product variation or a product switch, but in most cases, the better interest rate is normally a result of moving between lenders. And the first and most obvious reason to do that is to get the lower interest rate, which means that your mortgage repayments can become lower. And look, it's hard to say how much anyone would exactly save, but this could be up to thousands of dollars worth of savings over the lifetime of your home loan. And a number of lenders offer great introductory rates when you take out a home loan with them. However, unlike other industries, you're not rewarded by sticking with one lender for the long term. And in some cases, it's the opposite. Those who have not reviewed or refinance their loans can get stuck with far worse deals than necessary. And we must remember that banks and lenders are businesses, and sometimes it's far more valuable to attract new clients than to worry about the ones that you've already got or that they've already got. And this is where a good mortgage broker can really help in breaking down the fine print, comparing the products, doing the cost-benefit analysis, making sure that you understand what's available. And I think just on that point is that making sure that although we're not just switching loans because we can, we're making sure that we get that as a broker that I'm trying to put you, that as a broker, I would think that the role is more to do with putting the customer in a position where they feel valued by their lender. And obviously one of those measures, and sometimes the most important one, is how much they're paying. Obviously, if they're paying a cheaper rate, it means that, they want to be competitive and they want to be price attractive. And I think that also goes hand in hand with service in some cases. Number 2, better loan products. Back a while ago, maybe 20, 30 years ago, 40 years ago maybe, it was really just a matter of taking out a principal and interest loan and paying it. What lending was, it was just about taking a principal and interest loan and paying it off over the next 30 years. Fortunately though, things have changed for the better, and now there are a greater diversity of lenders and products in the market that do tailor to different kinds of borrower situations, and being put in the right spot can help you achieve some savings compared to other lenders. And a great example, and this isn't specific to any one lender again, but again in general, a great example would be a 100% offset account attached to your mortgage. And basically what an offset account does is that it's a transaction account which you can use for everyday things. However, because it is linked to your mortgage, it attracts the same higher rate of interest as your mortgage. So compare that to a regular saving or term deposit or whatever you may have. But more accurately though, the offset account, which is attached to your home loan, saves you on the interest expense that your mortgage repayment makes up. That makes up your mortgage repayment, in that you effectively only pay interest on the difference between your outstanding loan and your offset account balance. Hence, an offset account can really supercharge your progress if you park that spare money in there, and you can use that money in a smart way to manage how your cash flow or household cash flow works. And of course, having an offset, it's not a new thing, but like I said, it can be tied in with other different products which do make it even more attractive, but again, it's a very specific type of discussion that you would be having. Number 3, access to cash. If we haven't learned anything during the COVID crisis, it's that having some extra money tucked away for a rainy day is important. Fortunately though, if you're a homeowner who has owned property for any length of time, you might have built up some equity in your property, and that's certainly the case for owner-occupiers and investors in large parts of the East Coast, particularly in Sydney, where median house prices have risen dramatically in the last decade, mainly over the last 5 years though. And by refinancing, it's possible to access that extra equity and draw it out in cash as a refinance, and that money can then be used to buy another property as an investment or as required for any personal or business use. Again, just depending on having a lender that would accept the cash out purpose. It's quite possible to access equity and leave it in an offset account for sure. That way it's not costing you anything, but it's there if you need it. Again, speaking to a mortgage broker will be the best way to find out what you can do, because every individual's circumstances dictate how a lender will deem their eligibility or will deem their lending purpose. So I think this idea of accessing equity is quite important, because obviously, sometimes borrower situations aren't foreseeable, whether that be a life event or a business event. It's always good to have an understanding of where money can be made liquid, or where the most liquid money can be found, because you don't want it held up. You wouldn't want to be in a situation where you need money and then you can't get it. And like I just mentioned, say you need to do emergency repairs to your house due to a natural disaster type situation, having that money available as a cash out equity release is important, or would be important in that situation for sure. Because whether it be insurance and you've got to do stuff extra, or the insurance only covers so much, it's just a matter of understanding, if it makes sense and it's common sense, then that's where the value becomes apparent to the borrower. Because in most cases, a credit card might not cover it. And whether it be a car, or maybe it's your house or a holiday or something like that, that's where, or education expense or health expenses, I guess that's where being smart with your money really pays off. And lastly, number 4, debt consolidation. Not all debt is good debt, and when you buy a house to live in, or perhaps as an investment, that can be an example of good debt if it's managed properly. The asset that you're purchasing has a high likelihood of appreciating in value over a long period of time, which will leave you relatively better placed. Now, using credit or a loan to buy things that don't appreciate, like a new car or online shopping, this will get you into bad debt. And this is mainly because these things not only depreciate in value, but almost instantly come along with higher interest rates. High interest rate debt not only weighs heavily on your borrowing capacity because it's factored into servicing, but it is expensive to pay back, because there may be a balloon payment, for example, or there might be a exit fee, things like that. But an option when you refinance is to roll some of these debts into your home loan and capitalize on the lower rates of interest. Now, this is a great time to be borrowing money, and it hasn't been this good since, the 1950s. And with the economy facing a short-term downturn, it's important that, or it's more important than ever before, actually, to have access to cash, as we mentioned in point 3. And also, you don't want to be, at the mercy of some of these payday lenders or aggressive loan agreements that you may have entered into, because it could mean the difference between, borrowing that extra sum of money to send your child to school or to university. It may be the difference between helping your children get into a home of their own. It could be the difference between getting a second family car or a third family car. And, having that conversation with your mortgage broker about how you envision your life, not only immediately, but in the next 5 to 10, 15 years, that can really make a difference to what product that you want to choose from. Because as a broker, I don't think it would be in the best interest to just put you on the best product that suits your needs at the moment, even if you have disclosed certain life stages that you wish to pursue very soon. And given that this period of COVID and public health crisis, it is challenging, you just need to be not only sensible but disciplined with your money. And sometimes disciplined means, knowing when to take on more debt and also when to clear debt. So a broker can definitely help you get on the right track and help you understand what works best for your situation. And on that note, that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.